Ladies and gentlemen, here in this video, I want to discuss with you the broader economy because let's face it, the fears in Tesla are overblown. And I think we're going to have some upside surprises to Tesla, okay, from a business perspective. But there's also a lot of signs out there that we could be crash landing into a recession. Now, I will share this with you, my perspectives on what's going on. A clip from CNBC that I think you need to hear. And what could come of Tesla in the next couple of months, in spite of all of what's happening in the economy. And I do have to say, if you've paid attention to markets, to the Fed, to the economic data, to earnings, this should not come to you as a huge surprise. A lot of this information we already kind of know, but it's connecting the dots to this that rings some alarm bells with me. Now, let me be honest. I don't think we're going to have an 08, 09 kind of recession, okay? I think if we get a recession, it's going to be pretty shallow-lived in nature because, let's face it, we've already kind of had a large chunk of the economy think we're in a recession for a while now. If you are a lower-income consumer and middle class, you felt like we've been in a recession for a long time. A lot of that has to do with inflation and the cost of living crisis. Well, now what is happening is the upper income earners, business owners, people with stock, you may be higher income earner yourself. I guarantee you don't feel as confident today as you did 3 months ago on the economy. Okay. We see this reflected by consumer companies. Best Buy, Target, Walmart, Dollar General, FedEx, Nike, name the company, they've warned about the consumer. You see it a lot in the soft data. Soft data is a leading indicator to hard data. So I think to a certain extent, the damage is already done. Because what a lot of people don't know is consumers are not created equal. 50% of all dollars spent in the economy every day come from the top 10% of income earners. People that own fancy homes, that own stocks, that run businesses for the most part. What I think the root cause of the damage really is uncertainty. It's the velocity of money that is dramatically come to a halt. Why is that? Because if you're a company right now, whether you're Apple or you are a small business, in this environment, you're not jumping to conclusions to grow your business, let's say. You're not making dramatic decisions to capital allocation, right? As a CEO, as a high-ranking executive in a company, your only job is to really make decisions. It's not to run the assembly lines. It's not to run advertisement campaigns. It is to make decisions on where to invest capital, what strategic route to take a business down. Unfortunately, right now, that's nearly impossible. Okay, so tariffs is one thing, but tariffs are ever changing. So one day we may believe it's a certain amount on a certain country, and the next day it's canceled, and then the next day it's reciprocal, and then the next day it's not, okay? In that environment, there is no way to know with any kind of confidence where to invest or, how to invest, okay? Do you build a factory in the U.S.? Because, you're going to be tariffed if you don't? Or do you build a factory in Indonesia? Okay. Or India? Okay. Do all tariffs get dropped? In that case, building a factory in the U.S., well, doesn't make a whole lot of sense. You got duped, essentially, if you are a business owner from a business perspective. So I think that is really halting the velocity of money. And you can see this with consumer companies. As the consumer continues to slow down, which I think has been the overall trend now for 2 years plus, and goes into more debt and continues to be hurt by higher interest rates, as people slow down further, as I think is happening right now, you could, again, reflect it in consumer earnings, you're going to see, one, I think, disinflation, probably deflation in certain categories. And that's going to eliminate the inflation problem. But it could push you into a recession. Probably 50-60% chance of a recession here. It's not guaranteed, of course. But that is the road that we are headed down. Whether it is Treasury Secretary Scott Bessent, or it is Trump, or it is, anyone else that has kind of called for a recession. Even last week, you had Jerome Powell, which we know one thing. We know tariffs are inflationary. We know tariffs hurt growth. But the Fed is more concerned about the growth side of their mandate right now, not the inflation side. Even Austin Goolsbee on CNBC yesterday said that in the past couple of weeks, he has noticed a lot of anxiety, a lot of hesitancy around new projects and deploying new capital. And that even gives him a little bit of, nervousness, where he's a little bit more in the middle. He really doesn't know what's going to be worse. Is it tariff inflation? Is it inflation overall? Or is it going to be a growth slowdown? Okay. What we are seeing from the data right now, the best judgment we can make is you are probably going to see things slow down further from here. As Grok says, the soft data usually translates into hard data. Conclusion here. I asked Grok, does soft economic data usually flow through into hard data? This is soft data like PMIs, confidence surveys. Hard data is like GDP, unemployment rates, retail sales, industrial production, inflation, things like that. And soft economic data often acts as an early signal for trends that may appear later in hard data. This happens because sentiment and expectations can influence economic behavior. Example 1, high consumer confidence in soft data might encourage people to spend more, leading to increased retail sales, which is hard data. Example 2, a rising PMI in soft data often indicates business optimism, which can result in higher industrial production. Historically, soft data like PMIs and consumer confidence indices have been used as a leading indicator for hard data. Economists and analysts rely on these metrics to predict future economic outcomes, suggesting a meaningful connection. In conclusion, in general, soft economic data does usually flow through into hard data, providing valuable early insights into economic trends. However, this connection is not absolute. While there's often a correlation, the influence of external variables means it's not a perfect or imminent or immediate translation every time. Now, I think that's one side of it. Tariffs, uncertainty, all of that from a business perspective. And even to a certain extent on April 2nd, is that the end of it? Are you just going to be, take Trump's word for it that tariffs are not going to change or evolve? No, right? If I was a CEO right now and we get April 2nd, the tariff announcement, unless there is some kind of definitive, in writing, verbal promise that tariffs are not going to change, higher, lower, they're just not going to change, I'm not going to all of a sudden feel confident, right? It is going to take some time. And that's where you get into the recessionary dynamics, because this is a shock. This is a growth shock, okay? And as you're going to hear in a moment, the Smoot-Hawley Act of 1930 is really the reason we had the Great Depression to begin with. It is a huge shock to the economy. And unfortunately, it's not going away anytime soon. And probably a recession will be the thing that kind of makes Trump come to the negotiations table for free trade, right? That hopefully gives us a better trade deal longer term. But in the short term, it leaves stocks vulnerable. Because as I've showed you many times before on this channel, if you look at the headline S&P and an average recession, 15% EPS drawdown, 17x multiple, you're looking at about 341 on the SPY, which is about a 40% decline from here. If you even want to be a little, not as hawkish or as conservative, you could say maybe EPS comes in at 210 for this year, which is not too far off of EPS in 2024, which was about $237 per share for the SPY. But if you times that by a 19 times multiple, you're looking at about $399 on the SPY, which is still respective downside of about, give or take, 29% from here. I don't like that setup. Not at all. The question is, how long does it last? Do we have a sharp drop on markets and then we kind of recover quickly? Is it a prolonged period of downside? The average drop during a recession is about 10 months, which is pretty much what we had in 2022. So you need to be prepared for that to happen again in a more worst case scenario. Markets are not priced for that. And in Tesla, you're not priced for that. Even though you're better priced for that, as the stock is down 50%, if we did go into recession on the decline, right, that recession sell-off, you probably see Tesla back at about $100 per share, which, yes, is still a pretty dramatic decline from here. And it may not be as bad. Maybe, 140 is the ultimate level, but you're still looking at some considerable downside. So I think you really want to be careful in this environment. You do not want to have all of your dollars vulnerable to the downside risk at this point. Now, ultimately, recessions are healthy. Ultimately, recessions can make you rich if you know what you're doing. The sooner you notice a recession and the recessionary impacts, the more you can prepare for that. The more time you have to prepare for that, the better off you will be. I don't make these videos because they're popular or they're going to get views or anything like that. In fact, these more negative videos, more, I think, realistic videos on the economy are not well liked. They're not well taken, okay? But they have to be made for your better good, okay? If you take the opportunity to learn from this, that's up to you. You can lead a horse to water. You can't make a drink. Okay. And again, I'm not guaranteeing we're going to have a recession. Nothing is guaranteed. But even at a 50% likelihood, which is like what Jeffrey Gundlach says, 50, 60%, I'm roughly in that camp as well. That's too high to ignore. So as I've said before, I think you want to stay invested in this market, but you want to have as much cash as possible on the sidelines. If you're in risky companies that could go bankrupt during a recession, that need to raise capital, that may not be able to raise capital in the future, that's a no-no, right? If you're in a company, $5, $10 stock that relies on raising capital via issuing shares, and that stock could get decimated because it's highly unprofitable, no future of being profitable, like that is the company that maybe is not the best investment right now. Okay. On the backside of this, things are going to be fine. I think 2026, especially in the second half of the year, is going to be a-okay. That's more like when the recovery probably happens, in my opinion. If we do go into recession. If we don't, I think it's really a single stock market. I think a stock like Tesla could do very well if we don't go into recession. That's why I want to stay invested in Tesla. Because no recession, Tesla's going to do well. I don't think the headline S&P is really the best investment, even if we avoid a recession, because of how concentrated it is and how expensive broadly it is. But, Tesla, AI, that is likely the area to be in if we don't have a recession. Now, it's going to be the area that's going to get hurt the hardest if we do have a recession. But again, there's only a 50% chance, I think, of seeing a recession. Now, take a listen to what Citibank here and Ariel Investment says about recessions, the depression, and tariffs.
To the market action with Citi Research Director Drew Pettit and Ariel Investments Vice Chairman Charlie Babrinskoy. It's great to have you both on here today. And Drew, I'll start with you because I'm looking at your notes and you seem pretty constructive on stocks here given the drawdown we've seen in recent weeks.
Yeah, look, I think the message we're trying to send is stay the course. When we were talking about the first half of this year in December, it was about first half volatility. And then all of a sudden when you get it, in policy uncertainty, which a lot of people were talking about, then do you really need to freak out or not? Look, we understand there's still some uncertainty ahead around tariffs and the impact on earnings, but at these levels, let's call it 5,600 today, feel a lot better than we did when we were trading, north of 6,000.
Charlie, do you feel a lot better, especially as Mike Santoli put it just a few moments ago, we're in the midst of peak policy uncertainty?
Yeah, this may surprise you, Morgan. I get accused of being a perma bull. I've been pretty bullish on the economy for 4, 5, 6 years, and I'm cautious here. I think people are familiar with history, know how dangerous tariffs are. It is not an exaggeration to say that the Great Depression was caused by Smoot-Hawley and a trade war. Tariffs, the fundamental document in capitalism is The Wealth of Nations by Adam Smith, written in 1776, which made the argument for free trade. It is a foundation of our economy, the world's economy, and we are playing with fire. I think this is very still dangerous. I hope people are right who think that Trump is bluffing, but if he's not, and he's really going to put these tariffs on, it's going to be very painful and more painful than what's reflected in the market right now.
So, Drew, is this mainly a question of whether or not you think a recession is likely here?
I think it's how deep and how long. We've said this looking at the data over history is if you really want to know where the S&P was going in the 80s, figure out where GDP is going. If you want to figure out where it's going today, it's a little bit more about secular trends, not to completely divorce the two from one another. But look, I just think, recession is going to hurt the growth side of the market, but there's still some secular tailwinds. There's still a lot of focus on productivity. And I think there's a lot of levers companies are going to pull, and they're not just going to take tariffs and changes, just kind of lying down, sitting back. So to us, look, I'm probably more glass half full than Charlie is here. But at the end of the day, tariffs are a negative. We really do need to get past that if we want serious upside.
Charlie, on top of that, student loan defaults are starting to hit consumer credit scores. What's the impact, you think, of that going to be, and how should investors position if they're concerned about it?
I think you got to broaden that. I think it's not just student loans. I think it is the consumer got big payments from Washington in the COVID years, and they have gotten big payments that are now slowing down. And I think Brian Moynihan said something that surprised me. He said the consumer is in better shape than people think. I don't see that. In the portfolio companies that we talk to, we think the consumer is okay. There's obviously very low unemployment, but the consumer is feeling some strain here. And so you're going to see it with some higher student loan defaults. We're going to see it with credit card payments being a little weaker. I think the consumer is not in great shape.
So from my perspective, if we don't have a recession, you probably see Tesla stock back at new all-time highs by the end of this year. $600-700 per share wouldn't surprise me. Okay. If we do have a recession, I think it's going to get really interesting. I think if we have a recession, Tesla could fall to about $100 per share. That's my best guess. You could fall a little bit more, a little bit less, somewhere in that $140 to $80 range would be my expectation. Okay, because I don't think it's going to be an 08, 09 kind of recession. I think the average, 8 to 10 month drawdown in markets could be possible. And you're already in like a 1 month-ish drawdown. So another 9 months or so, another 7 months or so of a drawdown. If Tesla got down to those levels, I think the recovery would begin by the end of this year, in my thought, right? So in that scenario, Tesla could be a $300, maybe $400 stock by the end of this year. But I think it has a very good 2026 in that environment. Because I think the case for AI becomes a lot more relevant if we do have a recession. You know, cheaper labor, cheaper, ride hailing services, right? Overall higher production that comes with AI. There's a lot of accelerated use cases that will come out of a recession. And normally recessions are good for flushing out, bad capital, and good capital goes to work in good places, which I think Tesla is a good place to put capital to work. So from that perspective, I actually think we could have a much better 2026 if we have a recession this year for Tesla specifically, especially if you're savvy and you're buying the stock, $140 to $80 per share. I think you're going to do exceptionally well. Probably 1,000% your portfolio in Tesla by end of year 2026, right? You put 30 grand in, that could turn into $300,000 at $100 per share for Tesla, right? Tesla could be $1,000 stock by the end of 2026 if we have a recession. Maybe even more than that, right? So I think your return potential is much larger if we have a recession, although you would have to, stay the course during the drawdown as well. So that's kind of the way that I'm looking at things here. I think there's upside in either scenario, recession or not, but 2026 is going to look better for Tesla, I believe, if we do have a recession. Which I know sounds crazy, but I think it's like short-term pain, longer-term gains versus, shorter-term gains and maybe a longer stretch to get those longer-term gains. Just my perspective. Again, that's kind of how I'm looking at markets here. What I'm doing is I'm buying some Tesla here and there. I'm aiming for like 2 to 5 shares a week, just to average it. But the bulk of my cash is on the sidelines here. Getting paid 4%, waiting. Like Warren Buffett, right? You don't have to swing at every ball you see, but you got to swing at some of them. And if I got to swing at some of them, just because the cost of being out the markets is too large, I'm going to swing at Tesla. But I'm going to make sure I can grand slam the thing when I get an underhand throw. And that underhand throw would be Tesla, $140, $100, $80. Like, come on now. I will literally sell a kidney if Tesla's $80 per share. I don't know about you guys, but, point me in the direction to sell a kidney and I'm there. Kind of kidding, kind of not. But that's what I want to be prepared for this year. And I think, again, if we have a recession, rates are going to zero. I think the trade war is over. Nobody wants to risk a depression. Okay. And the recovery on that is going to be something explosive. 50% chance of that. 50% chance of business as usual. No recession. Let me know what you guys think down below in the comment section. Have a fantastic rest of your day. Oh, and by the way, we do have some data coming out next week. I should briefly mention this for you. You have secondary data, softer data as well coming out pretty much every day. Monday, Chicago Fed National Activity Index, PMIs that will be coming out. On Tuesday, CB Consumer Confidence, Fed speeches, S&P Schiller Home Index. On Wednesday, durable goods orders month over month. That's going to be very important. You're expecting a negative number, so some weakness in the economy there. On Thursday, you have the GDP growth rate final numbers for Q4, expecting 2.3%. Last month was 3.1%. Initial jobless claims, a little bit harder data there as well. And then on Friday, you have core PCE month over month, personal income, and personal spending. Those are going to be very important. Personal spending comes in weak. Oh, yeah. Recession fears are on again because personal spending really never comes in negative, and it did in January. If it comes in negative again, oh yeah, you have a bit of a problem on your hands. And it was actually the most negative you've seen since 2021. So let me know what you guys think about this down below in the comment section. This upcoming week is critically important. and even from a tariff perspective. We'll see what happens there. Let me know your thoughts down below in the comment section. Have a great weekend, and I will see you in the next one.